Now we'll practice some sample problems from the exercise. Number 5. In year 6, a donor gives 112,000 to a not-for-profit to buy a bus. Near the end of year 7, the money is used for the purpose. Donor made no provisions about the accounting. Which of the following is true? They received the money in year 6, and that time it increased net assets with donor restrictions. In year 7, they used the money. Now, before using the money, we need to move it from with donor restrictions to without donor restrictions. And then we'll spend it to buy the bus. So now let's see what are the answer options. Net assets without donor restrictions increased by 112. Yes, it increased because we moved the money from net assets with donor restrictions to without donor restrictions. Net assets with donor restrictions did not change. Of course, it changed, it reduced. Net assets without donor restrictions did not change. It is also not true because it actually increased the net asset without donor restrictions. Net asset with donor restrictions goes up by 120 and also goes down by 12. So, in year 6, it went up by 112. And in year 7, when we reclassified, it went down by 112. The question is asking about year 7. So for year 7, it only went down. So not the both parts are correct here. So the correct answer is here, answer A. Now let's see another example. A private not-for-profit entity receives 3 large cash donations. One gift of 70,000, which is restricted by the donor so that it can be spent for 4 years. So, donor is imposing a restrictions, you have to use it for 4 years. It's time-related restrictions. One gift 90,000, it is restricted to pay the salaries. Here is another purpose-related restrictions that donor imposed. One gift 120,000 must be held forever. It's endowment type and it's a permanent restrictions. Well, now we don't classify temporary and permanent restrictions. We just call it with restrictions. So of course this 120,000 will increase net assets with restrictions. And the income from that 120,000 will be used for food for the needy families. That means whatever income you are getting it, donor also restricted that will be used for the food. So the income from that investment or that endowment will also be with restrictions. So here in current year, income of 10,000 was earned but not spent. Before spending it, it is still with restrictions category. Now, what is the increase in the current year in net assets with donor restrictions? Well, all these are with donor restrictions. So we're going to add all up 70,000 plus 90,000 plus 120,000 plus the income here. So if you add all those, you will find 290. So add all these numbers, all have some restrictions imposed by the donors, including the income, until you use it for that purpose. So the correct answer is 290,000. Let's see another example. A private not-for-profit entity has the following expenses: research to cure disease, fundraising cost, work to help with individuals with disabilities, administrative salaries. So those are various types of expenses. How should the not-for-profit entity report these costs? You remember, not-for-profit entities must classify all of their expenses into 2 categories. One is program service expense, which must be related to the mission of the entity. Another is supporting service expense, which is related to administrative expenses and fundraising costs. So now, here we see the research to cure disease, and here work to help individuals with disabilities. these two actually sounds related to their mission. So if you add these two, 60,000 plus 40,000, that will be their program service expense, which is 100,000. Now other will be supporting service, fundraising, administrative salaries that they pay. Those are not related to the mission, rather those are supporting activities. So if you add these, fundraising costs 70,000 and administrative salary 90,000, which is 160,000, that will be your supporting service expense. So let's see the options here. And I think number A states the correct numbers. Program service expenses of 100,000 and supporting service expenses of 160,000. Remember, your mission related expenses, which is here research to cure disease and work to help individuals with disabilities, those are your program service expenses. On the other hand, supporting service means fundraising costs and administrative expenses. Now we'll practice few more problems. Problem number 15. A not-for-profit entity receives a gift, and these are some new furnitures from a retail departmental stores. The fair value of the furniture is $2,100, and they gave it to those several needy families. How they should record it? So remember, this is also a contribution revenues. Contributions cannot be only cash. It could be non-cash assets or goods, equipment, furniture. It could be some investment securities. So when you receive any goods or any equipment or non-cash assets, we have to record it as per their fair value. So of course that they will record as per the fair value. And later they also gave it to those needy families, then they will that time will show it as an expense. Now let's see. Number A, no entries are required. That is not true. They of course will record both the receipt of the furnitures and when they gave those furniture to needy families. They will record both contribution revenues and community service expenses. Record contribution revenues here 2,100 and community assistance expenses 2,100. Yes, this is correct. When they receive those furnitures, they will debit furniture, credit contribution revenues as per the fair value, and when they pay those furnitures to those needy families, they will record or debit community assistance expense and they will credit the furnitures. So B is the correct answer. C said record only a community assistance expense. Well, you have to do it, but at the same time before that you have to record the receipt as a contribution revenues. D, record only a contribution revenues. Of course you will record it as a contribution revenue or contributed revenue, but when you gave those, you also record it as a community service or community assistance expense. Number 16. George H. Ruth takes a leave of absence from his job and then work for full-time 6 months for a charity. When Ruth fills this position of finance director, a position that normally pays $88,000 per year, Ruth accepts no remuneration. It's a charity work. What entry you should record? Remember, anyone can also contribute services, right? They can work voluntarily without any remuneration, right? But you will recognize those entries only when two conditions are fulfilled. Number one, those contributed service actually increases the value of some non-financial assets. Number two, those contributed service require some extra skills. Then you can record those as contribution revenues. So now here, of course, Ruth is doing some high-skill tasks, the finance director task, which required some specialized knowledge and skills, and we can record it as a contribution revenues. Now, let's see the answer options, how they will record it. as contribution revenues of 44,000 and a salaries expense of 44,000. Remember, per year is 88,000. She worked for 6 months. Yes, A is the correct answer, because when they will record it, they will also show it as a salary expense. If she should not be here, they need to hire some other people to fulfill the position. So A is the correct answer. B, no entries should be made because no cash was paid or received. Well, you have to record it. Otherwise, you would have to pay, just because not everyone will do that task. You need some expertise and skills. So you have to record that entry as a contribution revenue of 44,000 only. Yes, of course you will record it as a contribution revenue in the credit side, but what will be on the debit side? Yes, you provided the service, and which is equal to the job of a finance director. Otherwise, you would have to pay salary to the finance director. So you have to also debit the finance director's salary or salary expense as a deferred revenues. It's not a deferred revenue. Now, number 17. A group of high school students, seniors, perform volunteer service for patients at a nearby assisted living facilities. So here, those are provided by some high school seniors. What type of tasks they did? They could be doing some tasks such as wheeling the patients in the park or calling games or bingos. Right, of course, if those group of students would not serve voluntarily, they might need some people to do these tasks and pay some minimum wages. But remember, those type of services would not need any expertise or skills. Anyone can do those type of services. And it does not fulfill the two conditions, FASB's two conditions. Either it would extend the value of your non-cash assets, or the task or service a not-for-profit is receiving would require some specialized expertise. Since the task does not need a specialized expertise, they should not record it, and it would not be a contribution revenue. So, what amount should they be reported as contribution revenues? So, if you see all the amounts here, the answer is actually D, because here they should not record it. The task does not need any expertise. Now, we'll review two quick questions related to conditional contributions. You know, conditional, unconditional contributions are different than contribution with restrictions, without restrictions. Contribution with donor restrictions versus without donor restrictions means that donor put some restrictions on the use of the money. On the other hand, conditional versus unconditional contribution means that to receive the money, you need to fulfill some conditions or overcome some barriers. And if you read your textbook, and especially page number 875, they wrote it very nicely and clearly about the conditional and unconditional contributions. If it's unconditional contributions, it's a straightforward, you record it right away. You record as a contribution revenue. How about conditional? So, there are two scenarios. If you receive cash already, but this contribution is conditional. Conditional contribution, and you already received cash, but there might be some other conditions. Otherwise, the money may be taken back by the donors, or you need to complete some conditions or overcome some barriers to use the money. So in that case, we actually record that as liabilities. Conditional contributions we cannot record as a contribution revenue. It's not a revenue, it's a liability. On the other hand, if there is any conditional promise or pledges, that means you will receive something in future. You just get a promise, or somebody made a pledge, but there is still some conditions. So if it's conditional pledge or promise, then you will not record it. So you have to read the problems carefully and check out the word whether there is any condition attached with that contribution. So we will go over these two problems. 23. Peyton Corporation conveys 60,000 cash to a not-for-profit. It is viewed as conditional contribution. So it is viewed as conditional. They didn't tell you the details, but it is a conditional contribution. And we just discussed that conditional contribution you cannot record as a contribution revenue. You have to record as a liabilities. Right. Now, what do you mean by conditions? If you read the FASB's requirements, that means the recipient needs to fulfill some conditions to get it or overcome some barriers. So, which one is true about this donation? It has been restricted for use in a future period of time. No, it doesn't seem like condition. It looks like more the later use of the fund. It's not about the receipt of the fund. The agreement requires that the not-for-profit to overcome a barrier, or it must return the money to Peyton. Yes, so they need to overcome some barriers, otherwise they will take the money back. So B sounds like it's a condition and it is related to this contribution. Peyton requires the money to be held permanently with all the subsequent income to be used to feed poor families. Well, it sounds like more donor restrictions to use the money. So it is talking about with donor restrictions. It's not talking about the condition and conditions of the receipt of the money. Peyton expects to receive a future return from the private not-for-profit of commensurate value. It's not that much related or does not make any sense. So number B is correct. The agreement requires that the not-for-profit will overcome a barrier, or otherwise the money they need to return back. Now you will see here 24. The Stanton Company conveys 23,000 cash to a private not-for-profit entity. It must be used for a designated purpose, and it also viewed as a conditional contribution. What we just discussed, if there is any conditions related to the contribution or somewhere you find the information it's a conditional contribution, don't recognize it as a revenues. Recognize it as a liability. So you have to credit side, you have to write it, it's a refundable liabilities, not contribution revenues. And debit side, of course, the recipient not-for-profit will debit cash. So now, which of the following is recorded by the private not-for-profit entity? Are liabilities. Yes, they will show this contribution, which is conditional, as a liability, and they call it refundable liabilities. No journal entry is made. You have to record a journal entry. You received cash, right? So contributed revenues reported within net assets with donor restrictions. No, you cannot recognize or record or credit it as a revenues. And contributed revenues reported within the net assets without donor restrictions. Well, it's related to the condition and condition, and of course it's a liabilities. So you don't need to record it as a contributed revenues. Now we will review some problems related to mergers and acquisitions. If you remember, when one not-for-profit entity acquires another entity and the acquired entity is totally gone, it's called acquisition. And for acquisition, the acquiring entity will record the acquired entity's assets and liabilities as per the fair value. Of course, we will also check the difference between the purchase price and the net fair value of the acquired entity. And we'll decide whether we'll call it as a goodwill or it will be a reduction in net assets without donor restrictions. If you see the acquired entity is predominantly funded by donations, charities, then the excess payment would rather be recorded as a reduction in net assets without donor restrictions. But if you see that the acquired entity would have some other sources of revenues, especially they provide some specific services and they collect revenues from there, truly some exchange service revenues, and not supported predominantly by donations, then the excess payment will be recorded as a goodwill. On the other hand, for a merger, two entities are being combined and operate together in the post-merger period. Here, it's not one entity will be gone and another entity will domain the other entity. Rather, two entities are combined and work together. Now, problem number 27. AB is a private not-for-profit entity. It acquires YZ and acquisition price is 1 million. So it's an acquisition. So YZ's assets liabilities will be recorded by AB as per their fair values. So the problem says YZ's net book value is 600,000 and fair value is 700,000. So we will consider the fair values and you see the difference between the acquisition price and their fair value is 300,000. Now the question is, what we gonna do with this 300,000? Should we call it a goodwill or a reduction in net assets? Now it says that the primary support for YZ will be contribution. That means YZ is predominantly supported by donations and contributions. They don't have any other specific service revenue type of sources. Then we will not record goodwill. Rather, we will call the excess payment as a reduction in your net assets without donor restriction. So basically, we will not record any goodwill amount. The question is what amount of goodwill will be reported? It is actually 0. We cannot record goodwill here. Number 28. BC and OP are both private not-for-profit entities. They combine to create LM. So it's now a merger. For a merger case, we don't know who is the acquirer. We don't know who is the acquired entity. Rather, both are now combined and working together or created a new private not-for-profit entity. So what we're going to do, we actually use the carryover method. Carryover method means that we will just add both parties' book values. That means for assets and liabilities, we will just combine the book values of BC and OP. That will be the new entities' total financial assets and liabilities. So now here, BC holds with a land book value of 300,000 and fair value of 400,000. OP holds a land book value of 500,000 and fair value of 550,000. So what is the reported land account? Of course, we are using the carryover. It's a merger scenario. We will use the book values. So one of their land that BC holds book value is 300,000 and another that OP holds, it has 500,000. So we will take both book values, 300 plus 500,000, which is 800,000. So the answer is A. Now let's see the last merger or acquisition problem. Here, Southwest acquired Northeast. The acquisition value was 980,000. That's the purchase price or the acquisition value. Northeast, the acquired company, it's an acquisition, not merger. So we will record Northeast's assets liabilities as per their fair value. We'll also check whether there is an excess payment. We'll also determine whether it will be a goodwill or a reduction in net assets without donor restrictions. So they say that Northeast, the acquired company, has two assets, no liabilities, very simple. Equipment, book value is 120, fair value is 150. Remember, for acquisition, we record as per the fair value, 150. The other asset they had is building, net book value is 500,000, fair value is 800,000. So we will record all of their acquired assets as per the fair values. So here, equipment 150 and building 500. Sorry, the fair value is 800. So 800 plus 150. It's 950,000. So the total net fair value of the acquired entity is 950,000. 50,000. Now look, their acquisition value or purchase price was 980,000. So the excess payment here is 30,000. Now we have to decide what it is. Is it a goodwill or a reduction in net assets without donor restrictions? They say that the entity is not expected to be predominantly supported by donations and any investment income earned. That means they provide some other services, they have other resources to generate revenues, they are not dependent on donations or contributions. That means in this scenario, we can record goodwill. And you already know the goodwill amount, which is 30,000. Just to recap, goodwill means the difference between the acquisition price and the net fair value of the acquired entity. Acquisition price is 980, and if you calculate the fair value of their assets, which is 150 and 800, it will be 950. So the difference 300, we clearly can record it as a goodwill.